Coming up today, stocks bounce back with the Nikkei having the best day since 2008. Are we out of the woods yet? Or has the tech bubble already burst? What are the best performing sectors? What's the Fed gonna do? And a look at the commodity market on the cusp of a response from Iran. Let's go, guys. And welcome back, everybody, to the daily market review. Getting a little bounce in the markets here today after yesterday's extreme fear day. Massive gap down to start the week. VIX got up to 65. Things have calmed down a bit here today. However, it's still really red up the front. You can see that in the market color. In fact, there's only two things green across the board: volatility and REITs, which I've just added into my sector table indicator here. And stick with me today because I'm going to show you a list of farmland REITs on the charts a bit later on and why that could be potentially a good sector to be in over the coming months and year. Apart from that, we've only got two sectors above their 20-day moving averages. That's consumer staples and utility. That defensive rotation started last week, is still holding up. Other than that, we've still got the S&P500, Nasdaq and Russell all underneath their 50-day moving averages. So even though we've had a bit of a bounce back today, there's still been some technical damage done to the trends. And just looking at a 5-day relative performance of the sectors, been led lower by consumer discretionary, energy and tech. And just looking at major markets, Bitcoin, Russell and silver, the real volatile stuff. Coming off these last 5 days as well, we've got treasuries, REITs and the dollar holding up the best. And just doing a bit of technical analysis on the S&P 500, even though we're still oversold in the short term here, could definitely have a little bit more bounce left in it. We did get these three downward momentum thrust signals showing the market's pushing really hard on the downside. And just going out to a weekly chart on the S&P 500 and just zooming in here, I'm expecting over the coming week or two, who knows, possibly even by this weekend, S&P is going to come down to that big psychological level 5,000 where it may find support. If not, then maybe by late October we come down to this trend line and might find support somewhere around this level, 4,800 down to 4,600. That'll coincide with that top we got in July last year. And just looking at this big sharp move we've had off that October bottom last year, just drawing a Fibonacci retracement on that move, we haven't even quite done a 38% pullback. A 50% pullback, which you quite often see in markets, would take us to 48.80. Otherwise, a real common area that markets pull back, also known as the golden pocket, around that 62% also level, where the market topped out in July last year. That would take us around 4,600 and have us meet that trend line, which I think is a very real possibility over the next 2 months, just because we just got so ahead of ourselves coming into July this year. It's very normal and expected to see markets pull back, and I'd say the best case scenario is we find support at 5,000, then bounce off there. If not, like I said, I'll be looking for 4,800 down to 4,600 as a big key level for this bull market to defend. And just looking at market structure and breadth, I've got a little bit of softening here in the amount of stocks above their long-term 200-day moving average. Even though it's still above 50 at 63, could potentially be forming a bit of divergence with the market. And we definitely saw a bit of softening in stocks making new 52-week highs today, outpaced by stocks making new 52-week lows, even though we got a bounce in the market. Still got a little backwardation in the volatility term structure with the 9-day, bit over a point above the VIX 30-day. Definitely cooled down today. I'm still 70-80% sure we saw the high in the VIX for the year yesterday at 65. Quite the uncoiling. Compared to previous times, we've seen the VIX spike up to that level. Just looking back in COVID and the GFC, fundamentals were way worse than what they are right now. That's the market's pricing of volatility going forward. Just looking at actual volatility in the realized volatility index, market currently moving at an annualized pace of 18.7%. Still well off those highs we saw in 2022. Market was moving around at 1.34% annualized rate. And even though we saw a real sharp spike in the implied correlation yesterday morning, that's come off quite a bit, now down at 32. And bond market volatility still well off those highs from early last year. What has moved a lot is the spread between stock market volatility and bond market volatility. Something I'd been noting back when it'd been hitting highs, how much more volatile the bond market was relative to stocks. That seems to have corrected quite a lot these past few weeks. Oil market volatility and gold market volatility still well off their highs as well. And the craziest reading we've got yesterday, it's actually blown this chart out of proportion, was the SKU index, price of out of the money puts. We see it every time. So many people are buying insurance on yesterday's open, and given the bounce in the deltas, absolute crush in implied volatilities, those puts would be already significantly underwater today, and they'll keep melting away until expiry as well. Yesterday morning was a great opportunity to sell puts on stocks you don't mind owning and don't mind getting put into your account at a certain strike. Just looking at the 2-year government bond yield, that's stabilizing as well, 3.99. Same with 10-year, reclaiming the support zone at 3.90. There's a bit of volatility in TLT. No doubt people were rushing to buy that Friday and yesterday. That's already pulling back. Good sign to see high yield bonds actually traded above their 50-day today. Be looking for this big candle to be defended. Dollar index. Going back in history, anytime we saw big risk-off moves in the market, typically see a flight to safety, including the dollar. It was not the case this week. What I'm really paying attention to see if we've seen the worst, at least in the short term, is the really risk-sensitive foreign exchange currency pair, the Aussie dollar versus Japanese yen. And what looks to me like a bit of a capitulation candle yesterday, this massive hammer candle. Be looking for that to hold, see whether we can get a good bounce here. And if so, that'll be the yen carry trade settling down. And that's really what spooked markets coming into this week after we got that bit of a rout in bond yields late last week. Carry trade, then Buffett chopping Apple in half, verge of a Middle Eastern war. Everything just kind of spilled over coming into the week with the VIX spiking to 65. Stick with me today because I'm going to show you a reason why Bitcoin may bounce back this week, as it's been recommended to a lot of new investors. So I'll touch on that a bit later. Gold just kind of pulled back from its all-time highs on Friday, still holding above its 50-day. Silver's a little more soft, crude oil as well. Not really worried about what's to happen in the Middle East, however that could change quickly. What really fell out of bed this last week was high beta stocks versus low volatility. Big defensive rotation out of momentum and growth into more lower volatile, higher yielding defensive sectors. You can see that in the pop-up in staples versus S&P. And discretionary stocks coming off hard versus staples. Inflation expectations also fell out of bed over the last week, starting to bounce back a little bit. And same with credit spreads. I'm watching this support level here for another sign of a structural change in this market. What's moving markets after hours as I speak is we just got earnings from previous market darling Supermicro Computer, SMCI. Came in with a pretty sizable miss. And just going down to a 5-minute chart after hours, we initially shot up almost 20% on the first candle. However, completely fell over since then. We're now down almost 13%. Quite a lot of volatility out there. And that's causing NVDA to come off 2% after hours as I speak. After it had a little bounce today's session as well. And so semiconductors is another sector I'm paying attention to as well. We'll be looking for this support zone as a bit of a key level on what has been the leading sector of this bull market. However, just going out to a monthly chart on semiconductors, we shouldn't be surprised to see more of a contraction as it did just get so stretched. Reversal signals here on the monthly chart, and just looking at the absolute price gain from the October 2022 bottom to last month, July, that's a 243% gain for the entire sector in under 2 years. So probably an unsustainable rate of change. And again, if we just draw a Fibonacci from that low to high, 50% pullback take us to 183. And quite often, like I said, you'll see that 61% pullback, which also just happens to coincide where the market's made major turning points before. So if we draw in a support box around there, 61% on the SMH, that would represent about a 40% pullback from highs, which again, for a very volatile, high growth sector, that probably's got a bit carried away. We shouldn't be too surprised to see that either. And that level could still be defended, and it could still be in a secular bull market too. However, there's also the possibility that that is the top for this secular bull market. However, nobody really knows. We won't know for at least another year or two. And I'd say if we took out these levels down here at 86, then it's pretty safe to say that is the top, at least for a couple of years. So this is one sector I don't really have exposure to, and I'm very cautious about adding any names that are kind of related to this sector. Like I said, what's actually been performing the best throughout this spike in volatility and fear is actually REITs. And later on in this video, I'll show you a list of farmland REITs that could stand to benefit from lower interest rates, or if inflation comes back, since they have leases indexed to CPI and they have a defensive nature to them as well, just like other healthcare and medical REITs do, offering some good dividend yields. And with bond yields plummeting, it's no surprise to see institutional money go into some defensive REITs here. But before we take a look at those farmland REITs, let me just get you updated with all the news, research and data out there. So we got the Nikkei having a strong bounce back today after that really sharp sell-off yesterday, as they always open before American markets. And there's a look at the bounce in the Nikkei after they had their Black Monday yesterday, down almost 13%, at one point 15%, almost the same as Black Monday in 1987. Today they bounced up over 9%, and again, this is one of the best performing market year to date, and I'll be looking for this support zone to be held as another key indicator for global equity breadth. But what about the VIX? Still elevated, still on a seasonally weak period. We're now just under 3 months away from the US federal election, which quite often sees a bump up in volatility going into that. So even though I think the VIX has already topped for the year at 65, I think it's a little too early to say we're all in the clear just yet. And like I said, we may not see the VIX under 20 or maybe 18 until after the election. Like I said, I'll be watching the Japanese yen, credit markets, and the real possibility of a full-blown war in the Middle East as well could further rock market. But what we saw yesterday Closing level of 37, that's actually the 96th percentile of a VIX reading. You can see here at the 50% level, more than half of all VIX reading are under 18. I think a lot of people will be surprised to know. On average, the VIX hangs around 16 or so. And you can just see, like most financial markets, we get those outlier prints that you just don't see in a normal random distribution bell curve. These fat tails is what makes financial markets different. And we've got the bears saying it's too soon to jump back into stocks. We'll be on the cusp of a significant economic slowdown that turns into a full-blown recession, which of course would take us into a bear market in stocks, off more than 20%. Others saying the tech bubble's already burst, as we have been getting some softening signs in the economy. That could lead to a massive pullback in AI capex spending. We've also seen a number of big tech CEOs over the last month or two offload a huge amount of stock. Jeff Bezos, Mark Zuckerberg, Jensen Huang. In fact, the CEO of NVDA sold $323 million worth of stock in July before the market tanked. He very well could have nailed the top. That certainly would have added a bit of heavy weight to the stock of late. However, it's still a small fraction of the shares he owns. Currently one of the richest men in the world now, approaching $100 billion in net worth. So it's no real surprise to see him take some chips off the table. On the other side of the coin, we've got some research coming out of Bank of America that says the recent sell-off is unlikely the start of a new bear market, as the telltale signs of a stock market peak have yet to materialize. Pointed that it's normal to have a 5% pullback. In fact, they occur on average 3 times a year, and pretty much every year we'll see a 10% correction or more. And like I said, we haven't quite done that in the S&P. And given the macro setup out there, weakening economic data, US federal election, yen carry trade, Middle East war, how stretched we got in tech, it wouldn't be all that surprising to see a 15% correction in the market this year. However, just looking at signals for a market peak, we're not quite there yet. Looking back in history, didn't get to that huge peak euphoria, speculative bubbles you normally see in a late stage bull market. And even though we got some signs of stress and building volatility in the bond market, it's not freaking out just yet either. As credit spreads, even though they're increasing, they're still well off crisis levels. And like I just showed you, the price action in high yield bonds is actually holding up pretty good. However, that could change. That's why we're monitoring support levels. But like I said, coming into July, we just got a bit overheated. Looking back in history at the performance of the S&P in all years, in the light blue at the top is the top decile, the top 10% of all performances. The dark blue is the top quartile, top 25%. And in the dark blue line is the median performance of the stock market. And you've got the bottom quartile and the bottom decile. You can see coming into July, we'd been pretty much performing as best as any year in the S&P 500, getting up about 17%, and we've quickly corrected, almost now coming back down to the median performance. And like I showed you on the chart, we get down to S&P 5000, S&P 4800, 4600, probably right back at that median level, and who knows, may just be another great buy the dip like it was in April. However, there's ways to position a portfolio that can reduce volatility if we are going into a recession and full-blown downturn, as well as still be able to stand up if the bull market powers on. Like I showed you, REITs have been leading of late. Also got utilities and healthcare holding up. And there's a look at healthcare sector XLV, just below its 50-day. Utilities holding up pretty good, but look at the price action in REIT. Didn't even get underneath its 50-day throughout this whole mess. Actually showing some really strong price action. And if you compare that with more risk and growth sensitive sectors like consumer discretionary, kind of technically broke apart, as tech obviously did as well. Sharp fall for retail stocks. Industrials took a bit of a knock. Same with financials. Energy as well. New multi-month lows. And even the strong aerospace and defense sector took a little bit of a knock. It's definitely REITs holding up the best here. And there's another visualization of this sharp rotation we've had this last week. Out of cyclicals into defensives. So if we don't see a sharp V-shaped bounce back in cyclicals, tech and semis, the trend may have structurally changed because we're seeing this global change in equity sentiment. Also momentum coming off sharply these last couple of weeks. And so as promised earlier in the video, here's a list of 6 land and farmland REITs not many people know about, nor do you really see them covered throughout financial media. The biggest being Texas Pacific Land. It's been around for a long time. Head and shoulders above the rest in terms of market cap. Has had a pretty good run these last couple of years. Doesn't have much of a dividend yield. However, coming out of Washington State is PotlatchDeltic, $3.3 billion. Land REIT. And they actually own timberland. Got a dividend yield a bit above 4%. And like most REITs, they've been in a bear market for a few years, thanks to high interest rates. However, if that changes, that's a tailwind for REITs. And on the other hand, if just like in 1976, when a first wave of inflation came down, the Fed thought it was done, they cut rates, actually caused a second and larger wave of inflation. Just like back in the 70s, commodities and land REITs can do really well because a lot of their revenue is indexed to inflation and has a defensive nature, keeps coming in regardless of the economy. Hit even more hard, Gladstone Land. They're more into the agricultural space, farmland, relatively small company, less than $500 million market cap, dividend yield 4%, that's well off its highs from early 2022. Other ones, Farmland Partners, T-John Ranch, and the best performing one the last 2 years, Maui Land and Pineapple. They do a few more things than land, so they're a lot more volatile. And of course, check your local stock market. Pretty much every exchange has one or two land or farmland REITs, and they can make for good diversification in a portfolio, given the current macro setup we're in. And there's a look at the entire sector with the iShares Real Estate ETF, which may have broken out of a stage 1 accumulation into a stage 2 advance. And just getting back to the stock market as a whole, we're getting news that yesterday institutional investors bought the dip whilst retail traders sold aggressively. Retail order imbalance ended the day at minus 1 billion, which is 2.5 standard deviations below the 12-month average. On the other hand, institutional investors bought the dip with 14 billion in net buy-in, 2.9 standard deviations above the 12-month average. And the options market was busy. Like I said, a lot of people buying put options. It's kind of like waiting for your house to get flooded and then going shopping around for flood insurance. I've said it before and I'll say it again. The best time to buy insurance is when you don't have to, when it's cheap, like it had been for quite a few months coming into this month. However, I'm pretty sure this is never going to change because people always chase recent price action. And unfortunately, for all those put buyers, they're really trading against history. We actually just got the third largest 3-day percentage increase in the volatility index ever since it's been created. And just looking back in history, out of the 19 top instances that's occurred before, only one of them, the market was lower a year later, just down 2%. So as history shows, maximum fear equals maximum profit. Those that have some dry powder, the discipline, long-term vision and patience can take advantage of this fear, and you can literally put bids in the market and all these fearful sellers will hit your bid and you'll take their shares off them for a discount. And so one reason we've got the semiconductor sector on watch, not only the price action and how stretched it's got, but you'll quite often see when markets and sectors roll over, the smaller high beta, real volatile ones can often create it first, breadth within the market. And Supermicro has been a leading stock in semis for a few years now, and it's the same old story every time. When growth slows down, spooks the market that's already been pricing in a huge amount of growth and not even announcing a 10-for-1 stock split. Usual trick used by the board to help juice the stock price doesn't appear to be working. Profit margin contracted 11.3%, down from 17.1% in the previous year, and just a huge miss on earnings. Analysts were expecting $8.12. It actually came in at $6.25, and it's gone out to a weekly chart on Supermicro. We're currently trading at $5.35 after hours as I speak, around the lows from yesterday. So I'd say if Supermicro can't at least hold above that base where it broke out from early in the year, that could be a structural change and another sign we may have just seen the top for a little while. We also just heard from Airbnb getting whacked in the post market as I speak. They also missed expectations from Wall Street. Revenue did increase 10%, but earnings came in a little shy, 86 cents below 91 cents expected. They project Q3 revenue to grow 8 to 10%, but they did caution about slowing demand come Q3. There's a look at the regular session going into earnings, closing at 130. There's the 5-minute chart after hours. Getting knocked pretty hard here, 16.5%, trading at 108, which just looking at a weekly chart is right around here, which you could also say is a bit of a support zone as well, down 105. And so the price action in this stock, just like Amazon, is a key indicator of consumer discretionary spending. And just like Airbnb, Amazon's come off a bit hard these last few months as well, and we'll be looking for this level to be defended on Amazon for a sign on discretionary spend. Who's also in the spotlight now is the Fed and Jay Powell. A lot of finger pointing going on, and they should have cut rates last week. A lot of people calling for emergency cuts, 50 basis point cuts. I've even heard they should be doing a 75 basis point cut. Stock market's down 6%. Come on. People are just so sensitive these days. No tolerance for pain. Stock market's off 6-7%. People act like the sky's falling. And sure, the Fed could have cut last week, and it will be interesting to hear from them come Jackson Hole later this month on the 22nd. See what the tone of language is from Jay Powell. Pretty sure he'll come out with calming, stabilizing language, reaffirming the US economy is holding up. Credit markets are holding up, inflation's coming down, and pretty much just give the nod that he is going to start cutting. But the markets might be disappointed if he doesn't cut 50 basis points, like a lot of people are saying he definitely should do now. However, I agree with Mohammed Al-Aran that an emergency cut, and I also think a 50 basis point cut would also make them look stupid as well. Because even though we've got the Fed Fund futures market pricing in a 71% chance that they are going to cut 50 basis points when they meet up next month. Quite often the Fed futures market can get really volatile with its pricing, a little too overexcited. And so I'd actually disagree with these odds. I think there's a bit better chance, maybe 50-50, that they cut 25 basis points or 50 basis points, because the fact is they meet again in less than 2 months on the 7th of November. They can just trim another 25 basis points then. And a little over a month after that, they meet just before Christmas on the 18th. And they can cut another 25 basis points then as well. So the Fed still has the opportunity to trim 75 basis points by the end of the year. Because if they come out and do 50 next month, that's them admitting they got it wrong. Could look really political just before the election. So I'd say for sure they're going to do 25 basis points. And then if the jobs market really does start softening more, doesn't bounce back after all those people that couldn't work from Hurricane Beryl can come back to the market, and who knows, maybe the unemployment rate drops. We get a 4.2 or 4.1 print again after the surprise 4.3 print last week. If not, they can just cut again in November and December instead of just doing a knee-jerk reaction and bowing to the market and doing 50 basis points. So that's just a bit of a contrarian opinion of mine. But like I said, I'd put the odds at 50-50 at this stage, and I don't think they'll do an emergency rate cut either. However, as we all know in financial markets, things can change quickly, and who knows, maybe the yen carry trade does have a lot more unwinding to do, so it is always possible. However, I'd say those chances at emergency rate cut, as they stand right now, probably less than 20%. Because just looking back in history at the 9 emergency rate cuts the Fed has done since 1987, and that's kind of when the Fed put started, with Alan Greenspan. After Black Monday, he came in, provided some liquidity to the market, and that was kind of like the first major intra-meeting intervention. And we saw it again with the LTCM collapse in 98, tech bubble burst in 2001, September 11, GFC 2008 saw a couple, and of course the pandemic. So I don't think the current conditions really warrant an emergency rate cut. That would kind of be just like a knee-jerk reaction. And the Fed doesn't form their policy based on the VIX index and traders and hedge funds hurting from having to unwind their yen carry trades. And just fundamentally speaking, the global financial system does not run on top of the yen carry trade. A lot of people seem to get carried away with that narrative a bit, in my opinion. And it can actually be a double-edged sword. If they cut rates, they're opening the risk for a resurgence in inflation, just like we saw back in the mid-70s. This is something I'd say Jay Powell's very mindful of as he actually lived through it. He's got a lot more experience in financial markets than we do. And so he doesn't have an easy job. And when he moves, he wants to make sure 100% that he's making the right decision. It's one of the worst things you can do as a central bank is start cutting, and then a few months later you got to start hiking again because inflation comes back. That makes you look even more stupid. Not only that, but trimming US rates could also add to the pain of the yen carry trade. And this is part of it. Not only the Bank of Japan surprisingly increasing their interest rates to 0.25%. And just think about that for a second. How silly it sounds. Global financial system comes to a grinding halt because one central bank raised their interest rates to 0.25%. Of course, it's caused some unwinding and some leveraged trades, but what's helped that is US bond yields coming down as well, narrowing the gap between US and Japanese interest rates. So if the Fed did come out and did an emergency 50 basis point cut, that could just add fuel to the fire of the yen carry trade. But for sure, we are seeing a bit of volatility in the bond market. Good thing is it does look to be stabilizing. Really don't want to see the 10-year yield nosedive anymore, but I'd say it's almost been like a bit of a tantrum. The bond market just demanding the Fed to hurry up and cut rate, which, like I said, could provide a tailwind and put in a bottom for the historic bear market in bonds. Got Vanguard thinking bonds can beat stocks over the next decade. That very well may be the case when just comparing bonds to the S&P 500, which is historically stretched in long-term valuations. However, at a starting yield, Fed funds rate just over 5%, it's not the best. We'd have to see real sizable recession for bonds to start outperforming over a multi-year period. So again, I'll make a bit of a contrarian opinion that we're not right on the cusp of a recession. Although there is a good chance we could see one next year. Just keep in mind that the US economy and recession and growth is not like an on-off switch. It's not like people are freaking out over the yen. The VIX spiked to 65, so now we're in a recession, like you'll often hear. Across many channels and social media, we just don't have the numbers there for an imminent recession right around the corner. And like I said, the print we got an unemployment rate last week, I think it would just surprise everyone if that contracted next month. And so if you think we're already in a recession, you're basically betting against Goldman Sachs. They're estimating third quarter GDP is going to come in at 2.6%. For us to be in a recession, that has to go negative by at least 0.1%. So Goldman Sachs would have to be wrong by 2.7% in their estimate of how much the US economy has grown in the third quarter. But people may overestimate how quickly the recession has come from when we do get these signals like the uninverting bond yield curve, which for sure the bond market is pricing in the real possibility of a recession next year. However, it was pricing that coming into 2023 as well. We've also got oil a bit soft as well. Maybe worried about demand. We're not really seeing a really good bounce back in China like we'd hope. So even though the inverted bond yield curve looks like it's about to go uninverted, there can still be a 6 to 12 month lag between that and the start of a recession. And just moving over to crypto, as I promised earlier in this video, it's going to let you know potential bullish catalyst for Bitcoin ETFs, and that's Morgan Stanley's 15,000 advisors been given the green light to go ahead and pitch these new Bitcoin ETFs. And it's only high net worth clients with at least 1.5 million that'll be targeted, and so that could cause a material amount of buying in these Bitcoin ETFs, as they'll be pitched the two biggest ones from BlackRock and Fidelity. And there's the iShares Bitcoin Trust. Got absolutely whacked yesterday, however, like many assets. Looks like there was a huge buy the dip on volume, as there was in the underlying asset. Pretty much touched 50,000 right on the nose and bounced off here at 55,000. And that's another support level in a risk-sensitive asset that I'm looking to be defended as well. Moving on to the geopolitical situation in the Middle East. Still waiting for Iran's response to Israel. Could happen any hour now, as they've vowed revenge. Potentially a bigger response than what we saw in April after Israel took out a bunch of their military commanders at an Iranian embassy in Syria. They took out a few more this time, and so we could see a large-scale response from Iran on all fronts. And American diplomats have been trying to cool things down. They have asked Iran to cool down. They're trying to negotiate ceasefire in the Gaza Strip. However, that seems to be falling on deaf ears. Israel has shown they're not just going to stand there and take further aggression from Iran, who, let's not forget, along with all their proxies, started this whole thing. And Iran is not also just going to stand there and let Israel take out their military leaders one after the other. Iran still consider themselves the top dog of the region. However, the reality is Israel, along with the help of the West, have far greater military and technological superiority, and it is an opportunity for Israel to step up and take leadership in the region. However, the scales become more balanced if Russia and potentially China come in and try and backstop Iran, just like the West has done with Ukraine, with Russia said to be delivering advanced air defenses to Iran. And who knows, this could potentially spill over to not only a Middle East regional conflict, but dare I say World War III. Because looking back in history, this is how it starts in one area of the world. Then you get the superpowers sending all their assets there. So if you've got Russian and Chinese assets in the Middle East fighting Western assets, then that's pretty much a world war and could spill over to the Middle East. Hopefully all that doesn't happen. However, we have to see how big Iran goes, how much damage they can inflict on Israel. Just keep in mind, Israel took out about 5 or 6 people in this latest attack, responding to Iran's attack on school kids. So if Iran responds and one of their missiles gets through and they kill 10,000, 20,000, who knows, maybe 100,000 Jews, then you're going to see a pretty big response from Israel and the West, likely targeting key Iranian military assets, their ability to launch nuclear weapon, along with targeting all of their leadership. Then we'll just have to wait to see how much Russia and China wants to help out Iran. So for the sake of innocent civilians, hopefully it doesn't blow over. However, there is a real risk. Just thought I'd share this interesting visualization with you guys today. The distribution of global market cap in 1900 versus 2023. A few key observations here. How big the British Empire was coming into the 20th century. Almost a quarter of the global stock market. Germany 12.6%. France 11.2%. Even Russia was up there, almost 6%. The US at 14.5%. Fast forward 120 years, look how dominant the US stock market is. 60% of the world's market cap. Europe, sad to report, been left way behind. Germany, 2.1%. What happened there? Japan still holding on, 6.2%. And Russia, not even on this map anymore. I think they're even less than Australia, the size of their stock market. However, after the United States, they still have the most amount of nuclear weapons. And there's a look at 42 country ETFs listed in New York and their current returns year to date. Once again, you can see in the markets the outliers. Performing the worst this year, Mexico, Brazil, Thailand. Performing the best, Turkey, Peru, and India. Only 3 stock markets up more than 10% year to date so far. Still got a few more up than down, but believe it or not, even after all this recent mess we've had, US stock market still up 9% year to date. There's the economic calendar for today. Like I said, this week, we're not getting much prints at all. Nothing really big coming out, leaving the market to trade on its own devices. Could be a reason for things to calm down. Get a little taste of the jobs market on Thursday with jobless claims. Then pretty much nothing out from the States on Friday, which could be a good thing going into the weekend actually. But the market is still on edge. We can see that in the fear and greed index, still in the extreme fear zone. And so we've gone a little bit into OT here, guys. Thanks for sticking with me today. That's pretty much a wrap for this turnaround Tuesday. Like I said yesterday, I was expecting a bit of a short-term bounce, for which we may still get a little bit more. However, we're definitely not out of the woods just yet. Do have a few broken technical trends and big support areas getting tested. And since the yen carry trade seemed to really spook this market, so that's what I'll be watching with the Aussie yen to see if that can stabilize. Volatility can come down and we can get a little bounce here, and that should help to calm the volatility market down as well. And who knows, when the VIX crushes, it can crush hard, so it could be back down to 20 in no time. But also be paying attention to signs of stress in the credit markets as well, as we do have elevated bond market volatility. And like I said, US election less than 3 months away. We may just be in for another month or two of elevated volatility. Thanks very much for tuning in, and I'll see you again tomorrow night. Cheers.